Hello and welcome to CIO Perspectives. I'm Sid Ahl, the co-CIO of Private Clients, Endowments, and Foundations here at Brown Advisory, and I'm joined today by Eliza Erikson, our head of impact investing and advice at Brown Advisory. She's been investing for over 20 years across basically all asset classes and geographies at some of the world's largest family offices and leading sustainable investment firms. I'm excited to be speaking with Eliza today about the broader market landscape, the future of energy, including the impacts of the war in Iran, as well as the state of sustainable investing and impact investing today. Eliza, great to have you here.
It's wonderful to be here with you, Sid. Thanks for having me.
Maybe we could start with a bit of your background, how that's shaped how you look at impact investing and energy innovation today.
Absolutely. So I've been fortunate enough to spend over 20 years working in sustainable and impact investing across both large institutional and family office contexts, which with some of the earlier movers in the space, such as Calvert Group and Calvert Impact, with Piero Migliar, who was the co-founder of eBay, and most recently, a very large multi-generational family office before joining Brown Advisory. And in these roles, I've invested, as you noted, across asset classes and industries capable of generating both financial returns and outcomes at scale for people and planet. This includes experiences across the multiple clean tech and energy innovation cycles with the scars to prove it. However, as we'll discuss today, I do believe that the imperative to invest in energy innovation and expansion has never been both so important, promising, and even economic in nature.
I'm excited to hit on that economic and nature point, which I'm sure we will discuss. Maybe before we really dive into things, a lot's been going on in markets the last couple of months. We haven't had the opportunity to speak to our audience. I'm curious just what's most on your mind today, be it part of what we're going to talk about today or anything that's going on in markets.
Yeah. So tying maybe the personal and professional together, I have twin daughters who are 17. So they're rising seniors in high school. So we're very occupied as a family thinking about the future in general. So exploring the next chapters in universities around the country, even in Europe. And this has really prompted me to think about futures in general and what those futures look like in a world where the pace of change is somewhat terrifying and exciting all at the same time. And so in markets and in my everyday work, I have, I think, the privilege of thinking about future proofing. So what I mean by that is investing in innovation that both harnesses the power of new technology while preserving high value roles for uniquely human capabilities. So in thinking about my children, the next generation, I continually ask myself, what does the future of work look like? What does the future of energy look like? Electricity, et cetera. And can we future proof that future? So sort of a personal professional response, but that's what's on my mind. But what about you, Sid? What have you been thinking about? What's on your mind?
Well, I mean, I guess if I were to tie it with that, I'm definitely thinking about my soon to be 13-year-old daughter and her growing relationship with all things AI and this push and pull of wanting our children to be very tech forward and AI conversant and getting them all of that at their fingertips, but at the same time being very wary of what can occur when one becomes engrossed in a daily communication with AI and how all-encompassing it can be for people whose prefrontal cortex is not fully formed. So that's definitely
Absolutely.
something on my mind, especially with how much time I've been spending thinking about AI, but just talking broader markets, because we haven't chatted with our audience here for the last month or two. I would just say, as much as we were focused on Iran throughout part of this period, it really is clear that what's defined markets has really been AI and earnings. I'm curious to hear if you think it'll still be the case, but staying at a high level, we just came out of an earnings season for the S&P 500 where earnings grew 27%, which is a really mind-boggling number. Yes, some of that was marking up NVIDIA and Amazon's holdings in some of these AI model companies, but it was still a mid-teens earnings growth. And the economy still seems to be on a pretty solid pace for 2 to 3% GDP growth. We've seen the big tech companies once again raising their estimates for CapEx and spending on AI. I mean, some of the headlines are just wild. Last week, we saw Berkshire Hathaway agree to invest $10 billion in Google. to provide even more capital for investment into AI infrastructure. Google, a public company with an enormous market cap and tons of free cash flow, raised $80 billion. That would have been the largest IPO in history if it was an IPO, but it was a secondary offering from a big company. In addition, we've seen SpaceX, who's going to go public this week, transition into a neo cloud player right ahead of their IPO. They're renting their two huge colossus data centers to Anthropic and Google for tens of billions of dollars. Anthropic raised $65 billion and then immediately confidentially filed for their IPO. So really, the sums of capital being raised are truly gargantuan to pursue this AI opportunity. That's having a big impact on growth, a big impact on tech earnings, and all of these bottlenecks for providing this compute, semiconductors, memory, optics, and yes, perhaps most importantly, power, which we're going to talk about today. A quick recording note, we're recording this on Monday, June 8th. We just had a fairly ugly day in markets last Friday that was particularly painful for this AI trade. The NASDAQ was down 4%. Semiconductors were down nearly 10%. Much of this seemed to emanate from the Broadcom earnings report last year, where they didn't raise their guidance and the stock dropped 14%. But to put this into context, their guidance is that they're going to double their AI revenue from this year to next year, from 50 to 100 billion. And they said it was going to be in excess of 100 billion, and that wasn't enough for market participants. Their earnings and revenues are going to grow 60% next year. So this market, particularly for AI stocks, has been incredibly strong and likely due for a bit of a correction at some point. And I would say we're all the way back to where we were checking my notes 2 weeks ago, for a lot of these stock prices. So we are hearing some more pushback about the cost of these frontier models and how investors are trying to figure out how much that might impact demand for AI. I'm sure this is going to be a bumpy ride. I'm not surprised by this volatility. I think the key thing that we're focusing on is that we continue to see these models getting better and better. We continue to see demand for AI rising. And still, this is a market defined by shortages everywhere across the supply chain. But I will stop there and just say this brings us to one of our key topics today, which is energy. And how are we going to get all the power needed for AI and everything else we need energy for? We've talked about energy innovation on some of these podcasts before, the rise of solar power, the need for lithium batteries, the resurrection of nuclear, the continued importance of traditional energy, and now, obviously more recently, the power demands of AI. What to you feels different today? And do you see us as being in an energy crisis today?
It's such an interesting time. I think the question we used to ask, which is sort of no longer as simple as sort of what is the future of energy? And the question today becomes, what kind of energy system can support simultaneously AI growth, industrial growth, geopolitical resilience and independence, affordability, all simultaneously? And sort of for investors, where are the investable bottlenecks and shortages that may really symbolize embedded value over time? And in terms of the urgency to rapidly and exponentially expand energy sources, you could say we're in an energy crisis. It's what a lot of people are saying. I, perhaps half glass full, prefer to think of it as an energy opportunity. As we all know, sort of pressure tends to create diamonds, and out of economic and global crises, some of our sort of best innovation is born. So really, the energy system of the future must be expansive, flexible, resilient, multipolar in terms of geography. And the current Strait of Hormuz situation that everyone's been talking about is a reminder that certainly that energy security and independence is not theoretical in terms of challenge. And that key dependency, or sort of what people are calling choke point risk, can affect oil, natural gas, shipping costs, inflation. But really, the moment is now to think more systemically. The investor takeaway is not really to just forecast the next price spike. It's to build a more resilient, diversified, affordable, and flexible energy system for the long term.
And do you feel like even just in the last few months, strategy around that will seek to incorporate maybe people's increased probability of these choke points being more of an issue going forward? I don't know if it's too early to tell, but
No, there's been a lot of, I think, momentum already in terms of, I would say, upgrading the investment theses to make them much more multidimensional and inclusive, sort of all of the above, including investing, as we'll talk about, in sort of the future technologies that are not yet economic, but the sort of urgency that national security provides and the need for energy independence, as we learned during the first round of the Ukraine war, and this is global and very systemic, has been a nice pressure point to think about a much more multidimensional solution.
energy transition, and it can be a tricky word, transition, because we are still heavily reliant on traditional energy sources, but it can sound like a climate concept. But as you and I have talked about a lot, the fast growth of solar and geothermal and wind and other renewables might be less about climate and more about economics and demand. What would you say? Is this about cost or carbon?
Yeah, it's a great question. I think a better way to frame the topic is in terms of the need for energy innovation, expansion, and independence. This is not only a climate and decarbonization issue. Increasingly, it's a pure power availability, resilience, equity, affordability issue. And as we've been discussing, and there's lots of data behind it, demand is skyrocketing. And the system needs cleaner, reliable power and more flexible infrastructure. We have very old infrastructure, as we've discussed. And so there's just a need for a massive upgrade in all of the above in terms of sources. And certainly, you mentioned climate, the current US political environment adds a layer, certainly energy policy and sustainable investing labels are contested. The regulatory backdrop is very fragmented across federal, state agencies, et cetera. So increasingly, which I think is healthy, the thesis has to stand on its own. It has to stand on investment and economic merits, factors such as cost, speed, reliability, risk management. We no longer have the luxury, which we can talk about, underwriting subsidy or policy support. And just a few examples that I love to give. Texas is a fantastic example. This is not a market people associate with, climate positioning, branding, or climate forward policies, but it is expected to add far more utility scale solar than the darker blue state of California. In fact, the Energy and Information Administration, or EIA, expects Texas to add 11.6 gigawatts of utility scale solar in the year versus just 2.9 gigawatts in darker blue California. Texas today produces and consumes more solar energy per capita than all of continental Europe. So it's just an example that it is not about politics. It is about cost over carbon. And solar paired with storage, just quite simply, is the most cost-effective and fastest energy source to deploy at scale on the grid right now, with natural gas taking some years due to bottlenecks in the supply chain. The other thing that's important to note is the large technology companies, which you've been discussing in your opener, driving AI development, known as the hyperscalers. They are using the all of the above approach to scaling energy for AI. Fastest and cheapest is going to win. And they're also even willing to bet on newer non-intermittent baseload sources that don't have the intermittency that solar and wind do, but are not yet economic, such as nuclear fusion and geothermal. So this is much less about ideology, much more about meeting a physical constraint and addressing cost, speed, and demand.
The Texas production versus continental Europe is just a statistic that will never cease to blow me back in my chair. I mean, it is the wild statistic. And I also like to talk about and think about the fact that for 20 years, we had basically flatlined electricity demand, power demand in the US. And now, it doesn't seem like a lot, but to grow that 2 to 3% per year requires a lot of additional power. Increasingly, the majority or vast majority of that coming online, to your point, has been renewable. So you're still very reliant on traditional energy and natural gas and what have you, but we've seen a huge growth in some of those areas, including geothermal. Maybe we could talk more just about AI, where, as we already mentioned, energy is viewed as one of these key bottlenecks to meet this surging demand for compute. As AI drives part of that 2 to 3% increase in power demand, how do you think about the energy needs alongside the demands for governance, regulation, and the community implications of data centers?
You mentioned the surge in demand, and we can talk more about this. What a different moment in time we are than in what's defined as clean tech 1.0. It was the early 2000s when some of these technologies, sort of renewables first, were tested. And so when we talk about being in an unprecedented era of energy demand, it's really the fact that by many estimates, global data center electricity consumption could increase by nearly 127% just over the next 5 years, 50% over the subsequent 10 years. And that is just an enormous demand shock and really unprecedented for a grid that we know is woefully unprepared. So that makes an investment opportunity that's real, but there's no free lunch, as always. So there are trade-offs that I certainly think about in my role. Data centers can certainly bring jobs, tax revenue, AI productivity. They can also strain local grids, resources, land use, ratepayer affordability. And our most recent election, and by most estimates, our future election, has been about affordability. Last round, the key symbol was the increasing price of eggs, and the upcoming election may very well be about the increasing cost and availability of electricity. Household electricity prices have increased by approximately 1/3 since 2021, and they show no signs of stabilizing. So really, my impact and sustainability lens is helpful. It forces us to ask whether the infrastructure being built is being built in a way that is durable, resilient, sustainable for both investors and communities. And then in that context, we have state and local policymakers increasingly focused on what regulation is going to look like, including, energy procurement, pricing, siting, environmental standards, labor and security. So for investors, we have a long history with sustainable investing at the firm. This makes it necessary for you to look at governance, permitting, community acceptance, and trade-offs as part of the underwriting while looking at the upside of AI. Is looking at those factors become critical.
What do you see as the current state of play for this data center development? I'm curious, we heard a lot about NIMBYism with respect to data centers. We are also hearing, in Silicon Valley or the big model companies talking about, oh, don't worry, we're going to cover the extra cost of your utilities. We're going to be striking deals or doing behind the meter deals or having our own energy supply that is off the grid. Where do you see this shaking out? Do you feel as if we're going to be able to meet the demands for energy for these data centers in a way that won't have a particularly meaningful impact on everyone's utility bills? Is this going to be entirely regional in terms of outcomes? How do you think about it?
Yeah, it's a great question. So we have here at Brown Advisory over 15 years of experience in sustainable investing and engaging with mid to large cap companies playing across both of these key sectors, traditional renewable energy alongside what we call the hyperscalers and technology, which are driving massive production development of AI and the demand for compute and energy. And increasingly, these two worlds and sectors are linked and interdependent. So spending time internally and externally engaging with the tech companies on how they think about the governance and community risks around data centers. And we can't ignore that opposition to new data center development is showing up across the country and the world. We've all heard about the situation in Ireland. We have a recent Gallup poll that shows that 71% of Americans oppose new data center construction in their communities. And there have been a range of successful campaigns to halt new construction in Kentucky and Virginia. And I don't think this will necessarily lead to a meaningful reduction in new data centers. But I think we more and more need to think about a dual underwriting case, which are sort of upside alongside governance, risk management, because I don't think planning for the probability that these will go ungoverned and unregulated for a lot longer seems naive. And the questions of how this will be regulated, front of the meter, behind the meter, overall, it's a whole new framework. I mean, utilities are actually pretty unprepared. So I can't read the crystal ball, but I think it will evolve meaningfully quite soon.
Maybe while we're on the topic of just how regulation might get included here, I'm just curious if you have personal views on some of the regulations or potential regulations that have been floated regarding just AI itself. The idea that Bernie Sanders is recommending that government takes 50% stakes in model companies, or the fact that a bunch of these AI companies are being summoned to Washington this week and potentially for taking stakes in them, or the idea of a token tax on AI tokens. Like, do you feel like this is also going to be a likely outcome, that there will be a heavier hand of regulation in the area of AI?
Yeah, I mean, I think as always, like the probably more extreme proposals in our current political environment are unlikely to go too far. But I think what is naive is to think that we're going to continue along at this clip without meaningful conversations between government and industry. I mean, this is a set of technologies and shocks to the system. I mean, we've had cycles before, but those have always been followed by some sort of framework between industry and government. And just the scope of impacts between what I was saying before, the future of work, the future of energy, affordability, access, equity, particularly to electricity, which we have long thought of as a public good. There's a set of conversations coming about who shares in the assets that are created, who is displaced, who shares in the wealth, that I think is pretty inevitable.
So maybe we can shift more into specifics on energy and the dynamics around renewables. I would love also after this to talk about some specific investment examples in areas you think are interesting right now for us to invest in. But maybe just starting with quote unquote clean tech, and some of these opportunities are in that. And as you mentioned, you have some scars from prior cycles. What leads you to believe this cycle will be different? We've talked a little bit about already, maybe just on cost, why it might be different. But what else is on your mind?
Absolutely. You can kind of think about clean tech as having had three distinct phases, really starting in the early 2000s. Clean Tech 1.0 is how we describe it, which goes from the early 2000s to 2013, 2013 to about 2020, 2020 to today. You can see the phases are shortening and accelerating. And if you think about the last 25 years, really three fundamental factors have changed, some more gradually and some very suddenly and recently. One, we've talked about electricity demand is rising. Second, energy prices have reset materially higher. And third, the economics of many of these newer energy technologies, renewables, et cetera, have vastly improved. And so I think there's a tendency to conflate Clean Tech 1.0, which was a very subsidy dependent, low energy demand context, uneconomic technologies, with what's happening today, particularly given our change in politics in the United States. But clearly, the current US political environment makes underwriting discipline important. So you have to look at tax credits, tariffs, permitting, technology specific regulation. But what's different from the early 2000s all the way to 2012 or 2013 is the opportunities today make economic sense. They solve a real cost, reliability, demand problem. Unit prices of electricity and energy are materially higher, and unit costs are materially lower, making the whole sector more profitable and investable. So again, this is not just about carbon. This is about cost, scalability. And when those prices reset higher, the opportunity set continues to change. So you can invest not only in power generation, but energy efficiency becomes way more valuable to companies, given the cost of those inputs. And the companies that maintain, manufacture, and service the energy system become much more important. So really, it's just the point is to say that those cost curves, the demand environment, and the sort of unit pricing has all really evolved. So now in the era of sort of clean tech 3.0, we're looking at a real investment thesis, an economic investment thesis. Just some information that might be helpful. Solar, wind, storage are now completely cost competitive with gas combined cycle, and they often can be deployed faster due to some of the supply chain bottlenecks for LNG. Storage costs, which of course have to be used with wind and solar to balance intermittency, have decreased meaningfully compared to the prior two cycles. And overall, this just leads to a material, more economic landscape for energy innovation.
So it's finally time, right? We've caught up on the tech, on the cost side. And as you mentioned, right, as everything else has gotten more expensive, it's hit from both sides. What about the bottlenecks in this market? What are the key inputs, needs for transportation, transmission? What needs to be built, and what are the implications of building it and the capital needed to do it?
There's definitely more work to do. I don't want to give everyone an impression that we've solved all the issues here. There's more capital that needs to flow, more work to do. According to Bloomberg, annual equity financing for energy innovation and climate technologies fell from a height of 127 billion in 2022 to 84 billion in 2023 to just 50.7 billion in 2024, somewhat likely due to the change in the US administration and political sentiment. And that funding reset may create, which is a good thing, more attractive entry prices, but the risks remain significant. We've talked about some of the more economic parts of the sector: solar, wind, storage. There are a number of sectors and industries that cannot scale and innovate and certainly can't decarbonize by buying those current renewables. So, for example, construction, shipping, aviation, all need new technologies that are not yet economic to reduce costs and emissions. And this is where deep tech and frontier tech and venture capital can be impactful, but definitely riskier, earlier stage. And we know renewables are important and solar and wind are critical, but they're intermittent. They're not equally distributed across the globe. And that creates a reliability challenge. This leads to investment opportunities in storage, grid, what we call clean, firm baseload power, which is unintermittent, like nuclear and geothermal. And so we need overall all of the above to receive more investment capital to be pushed up the economic chain. And just a few more data points to illustrate the gaps in capital. So by some estimates, annual storage, so energy storage investment needs to be more than 3 times 2024 levels. Nuclear nearly 9 times. The power grid needs 2 times more capital. And even economic renewables, 1.5 times to really scale to meet the demand. So those are overall some places where I think we have some work to do.
Well, the good news is you've got some of that capital and some of the families that you work with, that we work with, looking to put it to work. Maybe we could talk about some examples of projects or managers that we're funding right now, and how do they fit into your overall thesis? Where are the most interesting opportunities?
We're so intrigued by the space at the firm that we've developed our own multi-manager vehicle called Energy Innovation Partners. And we're really looking for managers across the spectrum, across asset classes and strategies, from venture capital and that deep tech, the new innovation, all the way to infrastructure to scale production and distribution of renewables. And an early investment out of that vehicle is in venture capital manager DCVC Climate Select. To just give you some background and then an example of a portfolio company, DCVC was founded in 2011. They seek to invest in early stage deep tech companies that are utilizing advanced technology, including artificial intelligence, proprietary data, and heavy compute to solve complex problems affecting large global markets. Several of their most successful investments have been in solutions for energy innovation. And so they started DCVC Climate Select really as a dedicated fund to capitalize on the success of those climate transactions, as well as select external deals from their network. And one example of a deep tech portfolio company that solves some of those last mile solution problems, when we were talking about the fact that certain industries such as aviation and construction can't take advantage of the currently economic renewable sources of energy. So they are invested in a deep tech company called 12. 12 is a developer of electrolysis-driven carbon conversion technology that turns captured CO2 into syngas. And what that does is basically produce sustainable fuels and plastics, typically made from fossil carbon. And there is a really interesting use case for that fuel in aviation that is sort of being tested now. So, this is an example of early stage, sort of last mile frontier tech, which is equally part of our investment thesis, as is the scaled renewable production through infrastructure.
And so when you think about that frontier tech and solving today's, but also tomorrow's problems, or maybe getting fully to that solution. How do you think about that opportunity set versus, as you mentioned, some of the current utility scale solar or infrastructure, or something maybe a little bit closer like geothermal? What's the balance that you're seeking?
Certainly from a risk return perspective, but also from the scale of the need, we kind of need it all. So we
Mhm.
very much think about a diversified approach that is multi-asset class, cross venture capital, growth equity, buyout, and infrastructure. And so in those technologies that are interesting, high potential, but not yet economic, that's a great fit, obviously, for venture capital. Geothermal and nuclear fusion are examples of very high potential technologies that produce scalable baseload power with none of the intermittency challenges of wind and solar, but they have not yet proven unit economics and scalability. Interestingly, unlike wind and solar, the regulatory context for both geothermal and nuclear is better than it's ever been under any administration. So you actually have some real tailwinds in policy and funding alongside a real need with AI, demand for that kind of baseload power. And so it may be over the next few years, we make material progress on those sources and their economics in a relatively short period of time.
So, how do we think about some of these technologies that are directionally important but imperfect today?
I mean, I think it is a matter of needing them as well. I mean, when you think about all the technologies that venture capital is invested in that have been directionally important but imperfect, it's basically the definition of the toolkit.
Yeah.
They come in before economics are proven. There are a handful of use cases, but the question of addressable market seems massive but untested. And so I definitely think it is the right place for this early stage capital to play. And as I said, with the administration policies being a bit bifurcated in favor of some cleaner baseload energy sources and less for solar and wind, there is actually a really interesting opportunity set right now to move further, farther, faster alongside, technology companies who are ready to take the risk, kind of have to take the risk of trying everything that's available and pushing some of these scalable sources sort of further up the maturity scale.
I will say it's always kind of struck me as out of balance the amount of money that is spent reducing carbon emissions in a fairly blunt manner when compared against the amount of money that's going into new technologies that could also play a big role. I mean, it's just like it's a factor of, 1,000, 10,000 more dollars going into the blunt force instrument rather than the innovation, and feels like we could change that ratio. You mentioned geothermal already a bit. There was a big IPO last month for a geothermal company, Fervo. Hopefully I'm pronouncing that correctly, which has performed quite well. I'm curious, do you see any signal in this for investors? As you mentioned, it's not particularly economic now. Geothermal, I think, is less than 1% of power generation globally, but growing quickly. What role do you see it playing in the coming years?
Yeah, and Fervo was actually a portfolio company in DCVC Climate Select, the manager we just discussed. So that was an exciting proof point for their energy innovation strategy and portfolio. And Fervo is really interesting because it shows how oil and gas capabilities, drilling, subsurface expertise, project execution can be redeployed into the production of clean, firm baseload power that has none of, as I said, the intermittency issues of solar and wind. And given the regulatory context is materially actually improved rather than deteriorated in the case of solar and wind, it's a really interesting time. It is starting from a low base, as you said, lower than 1%. But in terms of its potential, Fervo has this Cape Station project that is expected to start with just over 100 megawatts of power generation and to scale meaningfully from there. So it is certainly headed in the right direction, and it is a very useful example of pragmatic transition investing. Some of the expertise needed to scale the future of energy is definitely going to come from the traditional energy industry. And that's not a contradiction. It's actually a strong illustration of how this system can transition. So not to sort of talk in this circle, but it's a really interesting use case and a very important option given the issue of intermittency in some of the other sources.
So maybe I could close it out a little bit with just some of your conversations with these large families, these highly sophisticated investors who are thinking about these big trends in the context of their portfolios. One question is, what are they asking you today? And what are they thinking about in terms of doing in their portfolios? And then what are you telling them today as the opportunity you're most interested in, or the sizing of this type of investment strategy in aggregate in their portfolio? It's a few questions bundled up in there, but just curious, what you're hearing from them and what you're telling them.
So some of my larger family offices have been investing in this space for years. They tend to be most interested, not surprisingly, some of them actually made their wealth this way, in the very frontier and deep tech space. So they want to go earlier where the white space is to have the most catalytic impact, but also potentially meaningful returns. They're okay taking binary risk. And I think particularly as we're looking to deploy capital at scale for some of those families, helping them see the whole supply chain. And hopefully it's become abundantly clear through our conversation that I believe strongly that energy innovation is not just one venture capital theme. This is not just about climate tech. It shows up across the entire supply chain, from early frontier innovation all the way to deploying solar at scale through infrastructure investments with very strong cash flow. And so, just to walk quickly through the set of investment theses across the supply chain, I mentioned infrastructure. You can also use buyout investments where we can scale companies that manufacture, maintain, and service the energy system as it grows. Growth equity can back sort of software efficiency and applied tech to the energy system. And then we talked about venture, which can address deep tech problems and what I call last mile needs in terms of construction, real estate development. How are we going to think about cement, steel in the future? How are we going to fuel planes? Innovate further in battery storage. So I think if anything, in terms of where I like to play is sort of across the chain. And so that's how I've tried to guide some of my larger families who really want to deploy significant capital, is how to think about it more systemically.
So Eliza, having this whole conversation, you can't help but wonder, right? Because the market is so concentrated right now in AI related companies. The economy is fairly reliant on the growth that's coming from this big AI infrastructure build out. And we've got midterms coming up. We're going to have a new administration in a couple of years at the presidential level. What do you think could change that could alter the trajectory that we're on right now from a regulatory standpoint, from new legislation? What are you thinking about as we head towards the midterms?
Yeah, thanks, Sid. It's a great question. I do think it's important to ground ourselves in where in the political cycle we are. There are midterms obviously coming up this fall. The polls on the current administration are quite negative, even from the base. And there is the term of the day in several election cycles, including the New York mayoral election, is affordability. I sort of mentioned before the symbol of inflation getting out of control in the last cycle, and this challenge to affordability was the price of eggs. I do think the price of electricity and equity and access to energy by communities is going to be in the national conversation. It already is, but it will intensify in the lead up to the midterms. And I think this question of massive wealth and growth being created by AI being quite concentrated, the question of effects on affordability, and the fact that most of this technology is totally unregulated and ungoverned today. And it's sort of been moving too fast, so it's not surprising. But I do think there's going to be a reckoning and a set of national, local, and community conversations that will bring new governance proposals to play. So I think just as investors, we need to be mindful of that and not to be naive of where we are in the cycle. Often innovation outstrips regulation, regulation partially catches up, and there's this zigzag. And so I do think over the next few months, this is going to be an important national debate that we should just keep our eyes on.
And clearly also very important, as you noted before, that when you're thinking about investments at a project level or the managers that you're interviewing, that they are taking these things into account when thinking about what are the projects that they're going to be funding and where are they and what will the local environment be like for that, the state environment for that, and just pricing in a potential risk of how things could change over the 10-year life of an investment or longer. Eliza, this was great. Thank you so much for joining us at such an interesting time to talk about our need for energy and powering AI. I hope you'll come back sometime soon. Thanks.
Absolutely. It was a pleasure. Thanks for having me.
And thanks everybody for listening. We'll see you next time.